Hello everyone and welcome to the Week in Markets. You've got myself, Chris Leyland, Director of Investment Strategy. I'm delighted to be joined by George Bell. So George is my co-portfolio manager. So George, as always, a lot going on within asset markets, economic data coming out. Maybe just starting with Europe and interest rates.
Yeah, good place to start, Chris. So yesterday, European Central Bank reduced interest rates by 0.25%. So that was expected by the market. So interest rates now sit at 3%. They're down from 4.5% in the summer of last year. The European Central Bank have tried to make it pretty clear that their decisions around interest rates are going to be dependent on the data which they see, particularly around inflation levels and economic growth levels. It's not going to be determined by the glide path that the market is trying to price in. So at this point in time, the market is still expecting another 1.25% worth of interest rate cuts between now and September of next year. But what's enabling them to bring interest rates down? There's a couple of factors. One is inflation is cooling in Europe. If we look at core inflation, which strips out the more volatile components for Europe, such as food, such as energy prices, that sits at 2.7%. So it's above the 2% target, but it's moderated from 5.7% where it sat at its peak last year. But we've got economic growth, which is pretty weak in Europe. If we look at the latest GDP print, it suggested that the European economy expanded by only around 0.4% in November. And if we look at the projections from the European Central Bank, they were low to start with, and they've pushed them down even further. So in September, they said that the economy was going to grow by around 1.3% next year. Now they're expecting just 1.1%. And do things look better for 26? Not really, around 1.4%, and then the year after 1.3%. So pretty lackluster economic growth. There's quite a few headwinds at Europe at the moment. You've got uncertainty around Donald Trump, what the tariffs could mean for Europe overall. And then you've got China and the stimulus measures, which sounded very exciting when they were really set out into the market in autumn of this year. But actually, we haven't really seen a huge amount of traction or action come through. So there's a bit of scope for pressure and disappointment on Europe from those aspects. But they could also turn into tailwinds if the tariffs aren't as bad as expected, or we do see a more generous stimulus package come through from China. And we've got interest rates coming down as well. So we're going to have to just see how this plays out for Europe.
And just obviously within Europe, how are you thinking around Switzerland? I think we've got some news there.
Yeah, great point actually. You know, we've seen 0.25% interest rate cut from the European Central Bank. We saw 0.5% interest rate cut from Switzerland. So their interest rates now sit at 0.5%. So that was a surprise to the market. It was double the level expected. And the reason behind that decision is very similar to what we're getting out of the ECB. It's all around the fact that economic growth is slowing and they're seeing headwinds given the possible tariffs coming in from Trump and so on. What does it mean for Switzerland? Well, they might just be front-loading. They might just be trying to get ahead of the game and trying to reduce the pressure of interest rates before this turns more negative in terms of economic growth. It might actually put them in a position further down the line where they actually get back to negative interest rates given the need to sort of maintain their currency levels relative to the euro. So we're going to have to see what that looks like. But the general pathway looks as though European economic growth is pretty weak. Projections are slower than what was set out maybe in spring or summer of this year. So they're trying to get ahead of that. They're trying to bring interest rates down to release that pressure. And I suppose on inflation, it's not just inflation in Europe, which is in focus this week. Probably the bigger story is actually in the US. What were the key points coming out of the US?
Yeah, no, you're exactly right. So we saw US CPI, so US inflation, come in at 2.7%. So that compared to the previous month, which was 2.6%. So a very slight tick up overall. If we look at core inflation, so core is seen as being more stable because it excludes the more volatile pricing of food and energy. That came in a little bit higher than headline inflation, so it's remained higher than headline inflation overall. And that's really because of the difference that we see within goods and services inflation. But what I would say is both were really in line with market expectations. It wasn't a surprise when the numbers came out overall. As I said, a little bit higher compared to the previous month. Now, a lot of that is more due to the base effects coming out. So remember, it's a 12-month number. So obviously, as it moves on, you lose a month. And within that, rather than it being more focused around maybe like one certain area or something like that, there was less of a decrease in energy costs. So you saw gas and oil falling at a lower rate, and you also saw natural gas prices increasing. Just month on month, you saw the index rose by 0.3%. So again, in line with expectations, but it's a move up from 0.2% on the previous month.
And if you think about some of the themes that we've been discussing as a team, we moved away from the view of a more negative economic growth scenario, and actually some of the risks that we possibly see is inflation trending higher. So the print kind of was somewhat of a reflection of that, but the magnitude quite modest.
Yeah, I think that's fair. I mean, obviously there's been a lot of discussion, obviously with us internally, but we've had that discussion with clients and advisors who are watching our videos. In that, obviously, if Trump is adding tariffs, which he's guided that he will do, then that could be inflationary because obviously it pushes up prices overall. Now, what you have seen is that inflation, it has ticked up, but it is only very, very marginal. It's very much within what we see as being a fairly comfortable range.
Yeah, it's still a range in which markets can digest it and push on. And it wasn't just the CPI print that we had. We actually had a print which was a bit more focused around manufacturers and producer prices. What were the reports there?
Yeah, so we had what we call the producer price index, again, US focused. Within that rose 0.4% on a monthly basis and 3% for the 12-month period overall. So that's the 12 months to November. Again, that is up from October. So the two figures for October would have been 0.3 and 2.6%. When you actually look at the components, there is one component that stands out. That is food prices. So food prices were up 3.1%. Again, be careful there because food is quite a volatile component of inflation. If we just look at core, so again, just Xing out food and energy, that was up 0.2% on the month. So that was down from 0.3% in October. So a different trajectory there. You actually saw that come down overall. And on an annual basis, core remained at 3.4%. So again, core a little bit higher compared to headline inflation overall. But what I would say is, very much in line with expectations. You are seeing maybe a little bit of sort of stagnation in the reining in of inflation, but certainly from our perspective, not something that we're worrying about right now.
Super.
Excellent. And then maybe, George, just sticking with the US, some quite positive data out, actually. So the small business surveys, do you want to talk a little bit about that?
Yeah, so essentially it's as you say, Chris, it's a survey on smaller businesses just to get a feel for how they're feeling about things, how they're thinking about their outlook of their businesses. Are they looking good or things more challenging? And actually what we saw in America was quite a massive improvement. The index went from 93.7 to 101.7. So that's way ahead of expectations. In fact, it's the biggest monthly increase which we've seen since Donald Trump last got voted in 2016. So it's quite a material move. And really what was driving it, feedback on the survey was suggesting that it's the removal of the uncertainty in terms of the political outcome. Now, there's a lot of aspects within the outcome in terms of the actual policy that will land and be implemented that are still a little bit up in the air. But one aspect that they know is that the administration is probably going to bring with it lower tax and lower regulation. So that's quite a positive for smaller and growing businesses within the US. And there's also quite a clear willingness within the survey of businesses looking to get out there and spend again in terms of actually investing in their businesses in order to grow. And the index reading of that component, which is actually called the good time to grow and expand component, that's the highest it's been in a number of years. It's certainly higher than it was at any point during the Biden administration. So that was quite actually a positive index reading there coming from smaller businesses, which make up quite a large proportion of the US economy in terms of employment and economic growth contribution. But I mentioned China actually earlier, Chris, in terms of, they've talked a lot about stimulus packages through autumn. They were quite in focus in terms of our updates through the last quarter, but we did get another update from China. What was that?
Yeah, sure. So we had the Politburo in China. So what they guided is that they've changed policy from prudent to what they call moderately loose. Now, this is the first easing in, I think, 14 years. And it's basically a bid to boost demand, a bid to boost consumption in the Chinese economy. One of the comments that they came out with is that they feel that the economy and housing market in particular needs to be stabilized. There's obviously been a lot of problems with a lot of the ownership of the housing market overall. I think, what it does show, and I think this is a positive, is with Trump's tariffs coming in, they are doing something to address this. So again, for me, I wouldn't say it very significantly moved asset markets overall. I think we need to see a bit more coming from China. But for me, it's a good start overall. Yeah,
I think you've articulated it better than they have. Prudent to moderately loose. I mean, what does that mean? Well, I think you've explained it there.
Excellent. Well, just quickly before we go, coming up next week, quite a big week for central banks. So you've got the US Central Bank, the Federal Reserve, you have their decision meeting, and closer to home, in fact, literally at home, you have the Bank of England, you also have their decision meeting as well. From a data perspective, we have UK data on employment and also on inflation. So please do tune in next week, and please do like and subscribe to our YouTube channel to see more of these videos. Thank you very much.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.